Okay, let's talk about Peloton. Over the last few years, this company has been on one of the wildest rides you'll see in the business world. We're talking about absolutely meteoric highs, crushing unbelievable lows, and a brand that somehow became the center of a global phenomenon. To really get how dramatic this story is, you just have to look at these two numbers. It's pretty staggering. At its peak in early 2021, Peloton was worth almost $50 billion. Think about that. But just a year later, it had lost around 85% of that value. So the big question is, how did a company that seemed completely unstoppable manage to spin out so spectacularly? Well, to understand that, we have to go back a bit. Before it was a household name, Peloton had built something really powerful, a true cult following. And you know what? That following wasn't built on being available to everyone. It was actually the exact opposite. And this quote from the Wall Street Journal just hits the nail on the head. Peloton's whole mission, what they said they wanted to do, was make fitness accessible. But its actual success? That came from being exclusive, from being aspirational. It was way more than a piece of fitness equipment, it was a status symbol. So, what was the magic formula here? Well, first, the equipment itself was super high-end and expensive. Then you had a mandatory monthly subscription fee on top of that. And the content, with these charismatic, almost celebrity-like instructors, created fans that were just completely obsessed. It all added up to an exclusive lifestyle club mainly for people with money to spend. And then 2020 happened. The whole world shut down. Now, for most companies, this was an absolute catastrophe. But for Peloton, it was like pouring jet fuel on an already roaring fire. All of a sudden, you've got millions of people stuck at home. They have all this disposable income they can't spend on vacations or going out to eat. That money had to go somewhere, right? And for a whole lot of people, it went straight into at-home fitness. Peloton was in the perfect place at the perfect time. And the result of all that was just mind-blowing. The company's market value absolutely exploded, hitting that nearly $50 billion number we saw. It became one of the biggest, most talked about success stories of the whole pandemic era. I mean, just look at the scale of this surge. It's hard to even wrap your head around it. In 2019, the company was worth a very respectable $7 billion. By early 2021, almost $50 billion. That's a more than sevenfold increase in just a couple of years. The demand was, well, it was completely off the charts. And to put that demand into perspective, check this out. Peloton got almost 1 million new subscribers in a single year. The company that started as this niche, high-end product was now a global powerhouse. But, and this is a big but, underneath all that incredible success, some really serious problems were starting to brew. So even while the company was hitting these all-time highs and everything looked perfect from the outside, the foundation was actually starting to crack. This massive, sudden growth was putting enormous stress on, well, everything, from manufacturing all the way to delivery. And it was all about to come back to haunt them. The key concept here is this idea of unsustainable growth. See, Peloton was investing huge amounts of money to meet a level of demand that was created by a once-in-a-century global pandemic. They were basically betting that this insane boom was the new normal, that it would last forever. It didn't. And the first public signs of trouble were pretty basic. Logistics. The company just could not make and deliver its products fast enough. Customer complaints about huge delays and missed deliveries started piling up, and that really started to tarnish that premium brand experience they'd worked so hard to build. Then came 2021, and just as the world started to change again, Peloton was hit by this rapid-fire series of crises that basically sent the entire company into a complete tailspin. It really felt like everything that could go wrong did go wrong, all at once. It started in March with a truly tragic accident involving a child and one of their treadmills. That led to a massive, very expensive product recall in May. Then, as if that wasn't enough, vaccines rolled out, and by summer, gyms were reopening. Boom! Just like that, demand for at-home equipment fell off a cliff. It was the perfect storm, and by the end of the year, the stock had lost over 3/4 of its value. And in the middle of all this chaos, the company's strategies seemed, well, chaotic. First, they slashed prices, hoping to bring in new people. But with the world reopening, demand just kept falling anyway. So all the price cuts did was hurt their profits. Then, they made this really confusing move and reversed course, adding hundreds of dollars back in fees, which, as you can imagine, really ticked off their loyal customers. This was the moment the crisis became totally undeniable. In early 2022, the news broke that Peloton was literally halting production of its bikes and treadmills. Why? Because they had way too much inventory and just not enough people buying them. That news alone sent the stock plunging over 20% in a single day. So, with the company in a complete free fall, something had to change. And it had to change fast. The response was drastic, and it was aimed at completely resetting the company's future. Under huge pressure from investors, the founder and CEO was replaced. The company cut 2,800 jobs. That's about 20% of their corporate staff. And they brought in a new leader, a guy named Barry McCarthy, to try and steer the ship. Now, the choice of this new CEO is incredibly telling. Barry McCarthy wasn't a hardware guy. He was the former chief financial officer for two of the biggest subscription companies in the world, Netflix and Spotify. The message here could not have been clearer. Peloton's future isn't just in selling expensive hardware. It's in software and subscriptions. So where does that leave them today? Well, most experts see two main paths forward. On one hand, there's the full subscription pivot. They could transform into a truly accessible, lower-priced service, maybe even just focus on selling the app without the bike. The other path? If the turnaround proves to be just too hard, the company could end up getting sold to someone else. But no matter which path they choose, one thing is absolutely for certain. After a rise that was spectacular and a fall that was even more so, the road ahead for Peloton is going to be an incredibly steep climb. And that really leaves us with the billion-dollar question, doesn't it? Can a brand that was built from the ground up on being an exclusive aspirational status symbol fundamentally change its DNA and become an accessible subscription service for everybody? The answer to that is going to determine if Peloton can climb its way back to the top, or if it'll just be a fascinating memory of a very, very wild ride.